Very good. Well, good morning, good afternoon, good evening, depending where you are. We do this session on a weekly basis or almost weekly basis. I only skip ones when I travel, which I did last week, and which I'm going to miss on. Good morning, Alon. Miss on next week for traveling again. Speaking of traveling, for those of you who are in the Bay Area, and want to come and see me live in flesh, not online, I'm giving 2 lectures in Sunnyvale next week. That's this coming Wednesday and Thursday evening. And we're going to talk about, using, real estate to boost your wealth and how to invest out of state and what can you do and the process and everything related to real estate investing. Live in the room, we can actually shake hands and talk in person, and we don't have to go through some screen between us. So the events are on Wednesday, February 5th in Sunnyvale. The actual lecture starts at 7 p.m., but we do an early session at 6:15, which we call it a power session, which is a nice word for extensive Q&A and more of a open script, open mic, so to speak, so the group can ask and talk, and we go through different topics, whatever the attendees bring up, and then at 7 we start with the main presentation. The same thing will happen on Thursday, February 6th. The only difference between the 2 events, on Wednesday it is in English, and on Thursday it's in Hebrew. So you can choose either one or both. I even have people told me that the husband and his friend are coming on Wednesday for the English one, and the wife and her friend are coming on Thursday for the Hebrew one. So that's awesome. So you are most welcome to join, to share, to tell your friends. I'm putting the link here for registration. So I hope to see you if you're in the Bay Area next week for the session. If you can't make the 6:15 power session, that's quite all right. You can join at 7 o'clock for the main class. This is very much educational and and teaching and sharing information, and not as much sales speech. So by all means, Wednesday in Sunnyvale in English, Thursday in Sunnyvale, same location, this time in Hebrew. So with that said, let's move on to today's topic. And today's topic is something that I kind of thought about quite extensively. And by the way, while I speak, if you have questions, comments, something to contribute, by all means, please do so. I think it will be great to have it more of a 2-way conversation than a 1-way conversation. But I will say this. When I meet with investors, before I meet with them, and by the way, my career is been going on as a professional real estate person, someone who helps others for about 16 years now. And over that period of time, I have held probably more than 8,000, maybe even more than 9,000 by now, one-on-one sessions with investors. And in the past 7-8 years, every time before we start a conversation, we do a session, I call it a strategy session. I ask the investor or the person I'm going to be speaking with to complete an intake and kind of prep, something to prepare for the meeting. I found it to be very beneficial, both for the person I'm speaking with and definitely for myself. And one of the things that comes up is like, what are your main concern or concerns? Share with us, something about it. And that's something that always comes up. Hello, Afir. Good to see you. Alan Tzach, how are you? Great. Thank you for joining. And one of the things, people do share what their concerns. And I see over those years, I see patterns of what people are saying about their concerns. And many, many, many times, the concern of a down cycle, the concern of the unpredictable real estate market or economy is one of those things that come up quite often. Now, I am a survivor of the 2008 crash. What do I mean by that? Well, I went into the crash not prepared. not experienced, but not extensively experienced, and I had to figure out what to do during the crash and how to recalibrate my investments, recalibrate my strategy, and recalibrate how I'm handling the current investment that I have. It wasn't a pleasant period at all. Anyone who been through the crash and with multiple properties and exposure will tell you unpleasant times. But a couple of things happened during the crash, at least on a personal level. One, when the big crash happened, this is over a decade ago now, I learned a lot of things that I didn't even think I would need to know about real estate. The reality really had me dive into the fine details of different aspects of the investment and different aspect of the investment and different aspect of investment, even per state. For example, I never knew that the law is completely different regarding the recourse aspect of a mortgage, and there is a difference between states, recourse, non-recourse, and there's difference between if it's a purchase money versus a refinance. So there are all those nuances. Now, maybe it sounds super boring, and maybe it is to a certain extent, but those are the type of nuances that I have the unfortunate, privilege to experience. The other thing that happened is everything that I did at that time of the crash, I'm talking about the 2007, 8, 9, 10 period, because, maybe the crash was like bottoming at 2009, but handling all those problems lasted, beyond 2010. And when I say handling, I mean investors. I was dealing with problems related to this situation, economical situation. Investors that I work with were dealing with problems, and they would call on a daily or weekly basis, multiple phone calls, and they would ask for help, for guidance. One that would call, even if it wasn't my investor. Someone called with a problem, and I would definitely want to try and help. My logic was, maybe I can help that person because I deal with those things by myself. Maybe I can even learn from something that someone else is doing and benefit by myself, and maybe benefit and share that information with other investors so they could benefit. But a couple of things really really kind of stood out to me as I was going through that cycle, as I was kind of coming out of that cycle. And a couple of things that I really want to share with you that I think are super important. So think about this. The way I look at it is the following. We are going to have sooner or later, an economical downturn, right? An economical slowdown. That doesn't mean another crash. By the way, since the crash over the past 10 years, what we can definitely see that the state of real estate actually is much better, because lending practices got to be tighter or better or more strict. So in the past decade plus, the type of mortgages we've seen before the crash of 2008 and led, or contributed to the crash of 2008, we are just not seeing them right now or as much. We're also seeing a lot of cash buyers in the past decade. So in terms of the health of mortgages and the real estate, we are in a healthy position as an industry, as a market. So that's not like, this conversation is not saying we are heading in that direction. We're also seeing a lot of signs or strong signals and signs from different indexes and measures in the economy, for example, unemployment. But with that said, historically, every 10, 15 years or so, a downturn or a slowdown in the economy comes in. Now, I will say this. Assuming that's going to happen, and it doesn't necessarily mean a crash, but assuming that's going to happen eventually, I want to be myself, and this is what the advice I'm giving my investors. I want to be in the best possible position to weather that storm, to withhold or drive through that storm with minimal impact. Now, what are those things that I've learned 10 years ago that I am implementing today and suggesting my investors to implement? A couple of those things are Number one, buy quality properties. I know it's trivial, but I see a lot of people that don't do that. Quality properties for me means a nice house in a nice community, in a good school area, in a growing market. Very, very trivial, but a lot of people don't do that, right? A lot of people just go and buy following the herd, following advice for someone else. I still see people going into metros that are really picked by now, and they're still buying there because they think it's a good idea, or maybe a good metro, or maybe it's a good investment area compared to where they live at the moment. So those are not necessarily bad decisions, but are there good ones for the time they are in, or are they making the decisions, such decision in a smart way? So number one, quality, right? If you want to kind of vision what quality means, it usually means, think about Warren Buffett saying, I buy stocks in companies that have strong products and will have a lot of demand for those products. It's a very equivalent kind of mindset, right? So I like to buy houses in nice communities. It doesn't have to be top schools. It doesn't have to be all A schools, but in areas that are attracting good potential tenants, in metros that are showing signs of demographic growth. Okay, you can look online on U-Haul. You can U-Haul, the moving company. You can look online on I think America Van Lines. They have all posting. We have it on our website, on our blog. Every year we post the demographic changes or trends in the country. Some states, mainly the Midwest and the Northwest, are shrinking. Not all of them and not everywhere. And some states are expanding, right? If we are under the mindset that in the near future there's gonna be a slow period in the economy, where do you want to be? Where there is, I think the answer is very obvious. Because if we are in an area that is growing, then the chances of us going through the next slowdown and surviving it is better. Okay, so number one, quality. Number two, demographic changes, right? Number three, near big metros where there's more employment and diversified employment, right? Number four, don't be aggressive with your leverage. Actually, you don't have to be over conservative, but be a little bit conservative, 20, 25% down. See, when we were buying before the crash, I and some of the investors I worked with, we used to buy with 5% down and 10% down, right? 10% down typically generates a negative cash flow, okay? Which can be handled as long as you have a way to cover it, right? So if you're buying a property with a negative cash flow and it's generating, let's say, $200 on average a month in negative cash flow, but your job brings you plenty of cash, you can easily compensate, that $200, right? Even if you have two such houses, three such houses. But what I'm trying to get to is what happens if you have 6 such houses or 10 such houses, and all of a sudden you lose your job. All of a sudden you have $200 times 10 houses, that's $2,000 a month, that's burdening on you. I rather you, and this is one of the lessons learned from the crash, buy not 10 houses, but maybe 5, and not put 10% or down. Not that this is very relevant for investors today, but put 20, even put 25% down to be a little more conservative, right? So you don't aggressively buy in properties. You're buying, within your means. I like the fact that properties stay independent of us, right? If it's cash flowing, even a little bit, it has that buffer. It is independent of us. The house is not dependent on my financials. It's like divide and conquer, church and state, okay? So that's something that it's really important. So you can be aggressive with the financing, but you are more exposed. And you can be a little bit more conservative, making the houses independent of you, and then the houses, if something happened on your end, the house doesn't suffer, okay? So being a little bit conservative, quality area, growing markets, nice piece of property, right? And when I say nice piece of property, I do mean that American dream with a white picket fence. Sometimes I see those as I'm shocked how the cliche works, but it works. Nice house in a nice community in a growing metro. Guess what? the chances of you not having someone renting it during an economic slowdown or even buying it during that time they're not zero. But all we're doing here is tweaking the formula in order to lower, or decrease the risk. We're not eliminating the risk. We are risk decreasing. So that's the best way to go about it. So if you find that, if you go according to that formula, you are increasing your chances to success. Now, let me tell you one other thing. If we buy in a good area, in a good metro, in a good neighborhood or city, in a growing market, and let's say your plans are to hold the property 7 years, 10 years, and in 10 years, let's just say 10 years from now, to sell and move on, to liquidate, to get the money, to do something. And in 10 years, it so happens that exactly at that point of time, the economy slows down and it's not really a good time to sell. What do? Well, it's very simple. Nothing. You just hang on to the property a little bit longer, you wait for the economy to recover, and then you sell it. What's the worst that happened? You just end up with the same house that in a good metro, in a good area. Maybe right now, not a pleasant, experience. You just, kind of hold your breath a little bit and wait, 2, 3, 4, 5 more years and let the economy recover, right? I know it's not something we would necessarily want to do, but if that's exactly what happens when you're planning to sell, guess what? Just hang in there, a little bit longer. If you've held that property for 5, 7, 10 years by now, you're probably not going to break too much sweat for hanging on to the property a little bit longer. The worst thing you can probably do is try and sell at that period of time. Now, let me give you a very personal example. In 2005, September of 2005, I purchased a nice house, nothing fancy, in East Orlando. And that house was purchased for almost, I think, $180,000. At the bottom of the worst of the time, that house went from 180 to 84,000 or 84,500. It went all the way more than a half, right? Which I gotta say, seeing your house value goes down like this all the way to more than a half, that's not a very pleasant experience, right? Not a very pleasant experience. But something else happened that was very interesting, and I saw it on my properties and I saw it with other investors. Rents went up, vacancies went down. Rents went up and vacancies went down. So that means the cash flow improved. So while the value is still not fun thing to see, the house was occupied and it was generating. Actually, it was generating better. And on the top of that, some of us, what we did, because there was such an atmosphere of helping or changing and loan modifications and stuff like this, I actually have investors that lowered their interest rate for maybe 5, 6, or 7%, maybe 5 or 6%, all the way to 2% and 3%, right? The banks were more easy to work with and offering loan modifications to crazy rates, even 1% or 1.5%. Some of them were like 2% for 2, 3, 4 years, and maybe a little bit going up. Different programs, but what happened is if those investors who were not crazy nervous, right, and freaking out, and they have to sell because either life happens or they just feel overwhelmed, and hang on to those properties. And this was my message to those I spoke with, where some of them were able to actually get better terms on their mortgages and actually improve the situation in their favor because of the lower vacancy rate, because of the higher rates, because of the mortgage rates altogether. So those are small little tweaks, but all of a sudden, the person who is not going overwhelmed crazy and losing his mind kept the house. We know what happened in the past 10 plus years, right? And everything is fine, right? So it just needs a breather, just need a little bit more patience, but it works. I remember very well that I didn't, it was the first time I've been through a big crash. So I couldn't say for sure that it will recover. But all the signs were like, this is crazy. Houses out there are selling for prices that are lower than what it costs to build the house, itself. So that doesn't add up. That doesn't make any sense. And at the same time, inventory is kind of being yanked out by the banks. So the demand for housing is actually growing, at least for rentals. And on the top of that, just because we went through a crash did not stop the population growth. Population growth in the US by birth and by immigration continued to grow over those years. So all the things, even though I wasn't able to kind of say, oh, I know it will be okay for certain, just the indicators were showing me that there's going to be, better eventually. You just have to be a little bit, more patient. So what I'm trying to say is this: try to buy quality house. The decisions you're going to make today on selecting the right investment property will very likely protect you when something negative or slowdown happens. Right market, right community, nice house, the right house, and growing market. That all very simple to say, but what I see a lot of people, what they're buying, completely the opposite. They're buying a crappy house. I see so many that are buying a cheap, crappy house that is old and in a really not so good neighborhood, bad schools, and guess what? In a negative demographic changes state. Not always, but I see it quite often. Easier said than done? Absolutely. Can you always follow that model? Well, it depends what your appetite is for and what your tolerance is for. But if you just want to kind of steer that in a way that it will survive, most likely survive better, in economical downturn, you'll probably, if you follow those small advices, you'll probably do okay. Okay. And you know what? Be ready. It will happen. It will happen. That's historically, we know that the slowdown, they come every few years, and that doesn't mean necessarily a catastrophe. The last one was a really big impact on the country, emotionally, scars, financially. But see, this is the one that's a big one. So hopefully we won't see it again. I sure hope so. In my lifetime, I won't see it. I hope so you won't see it. But you know what? If you buy the right type of property and investment, you'll probably be okay, even when you go through some downturn. So with that said, I am done with what I wanted to cover and kind of point out. I just want to mention again, well, I see a lot of people join, and I appreciate it, and I see a lot of the names. But once again, I want to mention that next week, coming Wednesday and Thursday, I'm coming to the San Francisco Bay Area to teach 2 classes about investing, something that I just talked about will probably come in the lecture again, but it will be more extensive. It's more than an hour and a half of a class. So Wednesday, February 5th, and Thursday, February 6th, in the Bay Area. You can register. I'm putting the link to register. It's going to be in Sunnyvale. We start at 7 p.m. And for those of you who have the time and the desire, they can even come a little bit early at 6 o'clock for the power session that we're doing before every lecture. It's more of an extensive Q&A for you guys. So we start at 6:15 with the power session, and then at 7 o'clock we start with the main presentation, the main class. If you can't make it at 6:15 or at 6, that's fine. Come at 7 o'clock, not a problem. I try to start on time, and when I teach, I take a lot of questions. I share a lot of information. I bring 16 years worth of experience and over 4,500 properties purchased into the room, so everybody can benefit. So it's very much my style. I hope to see you there next week. If you are someone who was planning to come and meet with me one-on-one, which I do it on an ongoing basis, and you want to take this opportunity that I'm there for a one-on-one session, strategy session with me in person, let me know. Not a problem. I'm already booking meetings for my visit, in the Bay Area. So either one-on-one sessions, classes. By the way, Wednesday, it's a class in English. Thursday, it's a class in Hebrew. So you pick your preference. Let me see. I saw one comment coming in. And if you have any questions regarding the topic, regarding something else real estate related, or maybe regarding the meetings or the classes next week, by all means, please post it. Yeah, someone asked. Yeah, I'll pull it up and I'll check. So it'll be very interesting to see the today versus past investment. Not absolutely. We'll bring it up. Yep. Very good. So with that said, thank you, first of all, everyone, for joining. I see a big group today. That's always awesome. This session is being recorded on 3 channels. Facebook right here, YouTube a little bit to the right, and on our podcast. So you can consume this on either one, however you see fit. And I want to thank you for taking the time and spending your few good minutes this morning with me. I hope to see you in person, either at one of the classes or one-on-one next week in San Francisco Bay Area, Sunnyvale, Silicon Valley. Thank you, everyone. Have a terrific rest of your day. Have a great weekend and Shabbat Shalom. Bye-bye.